Sub-Saharan Africa has faced a bleak year this year, and this will continue into next year. The developments of this year threaten years of hard-won gains and have upended the lives of millions of people. No country in the region has been spared a decline in economic activity. The largest impact on growth has been on tourism-dependent economies, such as Mauritius and Seychelles, both down about 17 percentage points compared with our October 2019 forecast. Oil exporting countries have also been hit hard. On average, their economies will shrink by 4% in 2020. Similarly, other commodity exporters are expected to see their economies contract by around 4.6%. In the more diversified economies in the region, the likes of Cote d'Ivoire and Rwanda, activity will slow significantly but remain positive. In Nigeria, the economy will shrink by 4.3% in 2020 because of low oil prices, reduced oil production, and declining domestic demand. In South Africa, growth will contract by 8% in 2020, largely because of the impact of COVID-19. Most sub-Saharan African countries started to ease lockdown measures around the end of April, supported with somewhat higher commodity prices and an easing of financial conditions. There are tentative signs of a recovery in the second half of 2020. As a whole, the region is not expected to recover to 2019 levels until 2022. There are a number of risks around this forecast also, particularly regarding the path of the pandemic itself, the resilience of the region's health institutions, and the availability of external financing. Let me stress that despite the crisis, the potential of the region and the resourcefulness of its people, of course, remain intact. Tapping this potential will be vital for the region to find its way to a path of sustainable and inclusive development. And now, with fewer resources, policymakers face some difficult trade-offs. Fiscal and monetary policy will have to balance the need to boost and support the economy against the need to avoid debt and external sustainability problems. Moreover, if private financial inflows remain below their pre-crisis levels, the region could face a financing gap of the order of $290 billion. This is important as a higher financing gap could force countries to adopt more abrupt fiscal adjustment, which in turn could result in a weaker recovery. There is a need to implement governance reforms to improve trust in the rule of law, improve business conditions, and encourage critically important external support and private investment. At the same time, transformative reforms in the areas ranging from revenue mobilization through digitalization to climate change mitigation will help promote economic resilience. None of this will, of course, be easy, but with the support of the international community, the region should be able to successfully move forward, helping secure a more resilient and prosperous future for all.